off our CBC Middle Market Business Event Series with today's webinar entitled Preparing a Middle Market Business for Sale or Succession, The Journey to the Promised Land. And for those of you who don't know me, I'm Steve Tessler, Executive Vice President, Director of Sales with California Bank of Commerce. As a business and industry bank serving middle market companies in Northern California, our goal is to continually identify and address opportunities, issues, and challenges facing our business clients. And nothing could be more topical given current market conditions than sale or succession of a business, which is often one of the most life-changing, defining events that many business owners will experience. Furthermore, business owners are facing heightened uncertainty driven by what I would describe as a perfect storm due to the following circumstances: the pandemic, inflation, supply chain and labor market disruptions, potential changes to capital gains and estate tax laws, management fatigue, and everyone's approaching, well, not everyone, but many of us are approaching retirement age. So before jumping into our discussion, let's quickly meet our panel of experts. Mark Staley is a Senior Vice President and M&A Practice Leader with ClearPath Business Advisors. Mark has strong financial and operational knowledge, having helped numerous businesses achieve successful ownership transitions. Mike Sabri is a partner with the law firm of Donahue, Fitzgerald, has extensive experience in business and corporate transactions, having advised on many M&A transactions. Both Mark and Mike work and reside in the greater Bay Area, representing clients both locally and nationally. And before we get started, let me not forget a few housekeeping items. For best viewing, please set your Zoom view to side-by-side speaker view and to full screen mode. And in regards to questions, please submit them via the chat box so that we can address them during Q&A at the conclusion of the presentation. Also, and most importantly, let us know if you didn't get your complimentary DoorDash coupon. We don't want anyone to go away hungry. So let's get this rolling. And I'd like to start by asking a question to our panelists. And the first one is, there are a lot of reports in the news about M&A and how it's booming. And I'm curious what you both are seeing in the market with respect to this, and in your respective practices as well. So, Mark, why don't you start us off?
Right. Yes. Thanks, Steve. And it's true. M&A activity has had a huge resurgence since the pause or low point in the second quarter of last year. For example, during that time when COVID first hit, private equity refocused on portfolio company triage due to COVID impact in place of additional deal making. Coming out of that, we've seen record-breaking levels in the first half of this year, helped by low interest rates and sky-high levels of unallocated capital. Global PE investable capital is now at an all-time high of $1.9 trillion. And low-cost loans and higher levels of leverage are contributing to elevated sales multiples through the second quarter. The graph you see here shows the context for that run-up in activity. It's literally a stair step, as you can see from the onset of COVID. From that low point. Now, some might question whether the reported mega deals that you may have heard of out there are really the drivers of those results just by volume. And so looking at the breakout of deal value by size, it's even up for those in the under $500 million range, sort of on the graph there, the yellow and below. So that's good to note. And by quantity of deals as well, even under 100 million on the next slide here, the light blue and below deals under 100 million are carrying their weight as well. So another thing to note, there's a lot talked about private equity and they get a lot of press, but actually corporate acquisitions outnumber PE by about a 2-to-1 ratio, as you can see here. So that may be somewhat surprising to many.
Yeah, I, Steve, and Mark have a similar experience. It's unprecedented. I've been doing this for 30 years, which makes me feel old. But the last 12 months have been absolutely unprecedented as far as deal volume. And 80% unlike the charts that Mark just showed, in my practice as well as my firm, we've got about 60 lawyers and about 20 in our corporate group. 80% of our deals are private equity. So I think, Mark, really that they're just outbidding strategic investors because that they have so much access to capital. Either they already have it or it's almost free, based on interest rates. The three type of buyers that are out there are private equity. And again, that's where I'm seeing the most activity. Typically, those deals involve what are called rollovers. So you've heard the term skin in the game, perhaps. So the private equity groups want to pay, let's say, 80% in cash and then have the owners, shareholders, founders roll over the other 20%, sometimes a little bit more, sometimes a little bit less, but so that they can keep some ownership involved in the success of the new organization. And oftentimes, and I know Mark might touch on this a little bit later, get a second bite of the apple if the private equity group does what the private equity wants to do. The other one, strategic buyers, typically in industry, sometimes competitors. And then the smallest group, but really one that shouldn't be entirely ignored, is what I'll call succession clients. So internal buyouts, maybe by key employees, succession between one generation of a family to the younger generation. Those typically, I don't see a lot of. ESOPs are also something that shouldn't be ignored and in the right circumstance makes sense. But typically the people in the succession context don't have the same access to capital as those two first types of buyers, really are kind of risk averse as well. So unless there's a unique circumstance, and I have one now where there's a bakery located in Northern California, I'll say, and they want to make sure that their employees, many who've been there a long time and are loyal, are going to be kept. And a lot of bakeries, if you've been reading the paper, have been sold. They move all the operations out to Fresno or somewhere else with a much less expensive employee base. And then every morning at 3 a.m, ship the bread out and claim that it's still coming from the Bay Area. So that's a unique where the owners want to sell it for less than fair market value with those strings attached.
Mike, I will say that we have seen more instances recently of ESOP transactions. So those seem to be popping up more frequently than I've noticed over the past 3 or 4 years.
Yeah, the tax deferral component of that, Steve, is an incredible opportunity for medium to large privately held businesses. So we don't have the time to get into detail with ESOPs at this stage, but if anybody is interested, Mark and I can certainly answer any questions about ESOPs and connect them to the right people.
Absolutely, and we're seeing that activity as well, and have a couple that we're involved with have been long-term and interest in developing. So we're seeing the same thing on our end. A fourth source of capital right now, it's a newer trend, is significant amounts flowing into what are called special purpose acquisition companies, or SPACs, which has been at a somewhat staggering pace. These are essentially shell companies that go public to raise funds and create so-called blank check opportunity to acquire or merge with a private company. So this has created a whole new pool of potential buy-side investors, and allows for greater access to capital, without a corporate or PE buyer. This last year alone, almost 250 new SPACs were created for a total of $82 billion. So that's something just to be aware of as a third or fourth potential. When it comes to activity in the market too, on the seller side of the equation, a great deal of this, or at least interest, had been driven by these looming tax changes. We recently had an opportunity to tune into an Association for Corporate Growth event, specifically on the impact of proposed tax changes on a company sale. And understandably, primary impact will be on changes to cap gains rates. They're looking at taking cap gains tax to 39.6% rate for households over $1 million of AGI. And as an example, the impact, many of you on the call who are following these developments may have done some of this math in your head, but it's significant, in an example of, as you see on the screen, $5 million company, assume 7 times multiple. It's quite significant. So, are there going to be ways to mitigate, using installment sales. That's a possibility. Is it too late to avoid the tax increases? That's uncertain there. There's not a lot of time left potentially. So the specter of probable looming changes have a lot of people at least focused on the possibility of making an exit near term. Other issues driving activity, sort of continuation of a theme on the aging baby boomer business owners, as Steve mentioned, who are looking for exit or transition. But also, we're hearing a lot about concerns over the future of the marketplace. And coming out of COVID, owners who survived or actually prospered in many cases are wondering what's next with an enhanced appreciation for risks that are out of their control. So it makes one step back and think about those things. You add to that, some analysts, including ITR Economics, which is one we follow, who's had an incredible accuracy track record or projecting potential Great Depression down the road. So all those things considered, I think Steve used the term perfect storm. High money supply, a lot of developments in the industry, aging baby boomers, tax changes, et cetera, have really generated a lot of activity.
Well, there have been some stories this week that seem to indicate that the amount of the increase in cap gains rate might be more moderate than what had originally been thought. So
we'll take it.
Yeah. Anecdotally, Mark and Steve, I'm seeing the exact same thing.
Good. So what should middle market business owners be doing now if they want to sell their business in the next few years?
Well, simply put, the phrase I use is to get ready to get ready. It's a longer road than most might think. And some aspects you can't control, but others you can. So you want to know what to focus on and what actions to take to improve. We think this is best illustrated by our firm's tagline, which is, we believe business owners should build a healthy, sellable business, whether they plan to sell or not.
So how do you do that? And what does the market value?
So value in the market, I think most folks on this call likely know that companies in the mid and lower mid market, anywhere from 10 million to $500 million in revenue, are by and large valued as a multiple of adjusted EBITDA. So ideally, you want to look to impact both your EBITDA and the potential multiple to the best of your ability. So what are specific things to pay attention to? What are the things that increase value? There are a number of key drivers, both quantitative and qualitative. The first really is to have a good growth story. Starts with, hopefully it includes recent historical growth. It's a good position to be in, but also really a solid strategy for the future, a roadmap. It's not just for you, but in the M&A context that a buyer can see as believable, measurable, and executable. The next one would be strong gross margins as compared to your industry. And really, more than a number, it drives a need to understand where you make your money. So depending on the answer to that, follow-up question is, does a product SKU or product line or channel rationalization make sense? That is, to possibly cut unproductive or unprofitable activities or products so that you can improve that. We're seeing a lot of current pressures here. Steve, you referenced some of these: supply chain shortage issues, pricing of inputs and cost of goods across the board, putting pricing pressure, for your own products or services, labor shortages and retention. On that point, our org health and recruiting division has been particularly busy recruiting for talent. And so then the next one will be solid and growing EBIT dollars and margin percent. Again, at the end of the day, that's the result of what the buyer is buying or what the end game is. So everything else that we're talking about supports healthy EBITDA. So that's the ultimate measure of the success of the other drivers. When we talk about another enhancer is recurring revenue, and this can come in several forms. Yeah, you're probably familiar with businesses that have a model that are either subscription service or maybe software as a service or license fee model. Those things that can be quantified, modeled, and repeatable. And when you wake up the next day that income is coming in, they get rewarded with high multiples typically. In the absence of that, do you have long-term contracts with key customers? Or do you at least have a track record of long time and repeat customers? And to the extent you rely on new business or new customers year in, year out, then you need to have a sales and marketing machine that delivers that predictably. Do you have competitive advantage? Are you a leader or a commodity? How are you differentiated? Or are you? If you are, how do you maintain that lead? If you don't have it, how can you create it? So that's a big one. Strong sales and marketing capabilities. So a team that it's professionally staffed with state-of-the-art tools, processes, KPIs, et cetera, a solid CRM tool, projections, reporting, and accountability on all of that. As well, and this is super important, is depth and strength of senior leadership. If you want to make an exit, this is an absolute must. If you're able to literally step away for a month and have your business run as good or better than with you there, then you're in good shape. But you also need to look at the longevity of senior leadership. Will they last through the next holding period, or at least long enough to backfill themselves again, in the next 5 plus or minus year timeframe? If not, it's important to look, at the areas that need additional strength. And do you have a strong culture? One that's driven by values, mission, vision that are lived by the company and employees daily. That can be useful for and really essential for recruitment too, to make sure you get the right fit. And the bottom line there is resulting in high retention, low turnover, and full employee engagement. Next would be the form of entity, or the corporate form. Are you a pass-through, an S Corp or LLC, which is typically preferred as it allows for either a stock or asset sale structure. While we rarely see it, a C Corp can complicate things, can be a detriment to either to value or net after-tax proceeds, certainly, due to the double taxation associated with an asset sale in that situation. Mike, do you want to comment on the corporate form?
Sure. Yeah, I can discuss that. I think what I believe, and I think that's the way you described it, Mark, is really what you're talking about is an entity form, and the typical entities that we see are LLCs or S or C corporations. Because of where we're located, we predominantly see California-based entities, but there's also a lot of Delaware entities and other venues. Really, the key takeaway there is buyers are looking for some sort of a limited liability entity. And when I say that, I don't mean it has to be an LLC, but something like a corporation or a limited liability company, not a general partnership, not a sole proprietorship. The other thing I would add is, and I'm not a tax lawyer and I don't play one on TV or on webinars, but really get tax advice up front, because what's most important to you as business owners is what are you going to take away from the sale, right? If it's a $50 million sale, but you only walk away with 20, that really is not going to be the same as perhaps a differently structured deal where you walk away with quite a bit more. By structure, I mean, there's really 3 different types of structures of a sale. Number 1 is an asset purchase. And that means the company is selling all of the assets, including the goodwill, including the name, intellectual property, et cetera, but keeping the shell and typically all the bad stuff in the shell, like unknown liabilities, with the seller. So that continues to be the gold standard from buyer standpoints. They would love to do asset deals almost all of the time if they could. Because it's a seller's market, I'm seeing more and more stock sales or membership interest sales if it's an LLC. So that means the individuals, let's say there's 3 owners, 3 shareholders, they sell their stock to the buyer. The buyer then steps into their shoes and owns the entirety of the entity. That typically is almost always more tax efficient and friendly to a seller. It also allows the seller an easier chance to walk away. There's still indemnities and that sort of stuff that come with it. But for the positive reasons, sellers like a stock sale. The negative reasons, it's not a zero-sum game, or why buyers don't necessarily prefer that. But I think it's really important, and I think ClearPath does a very good job of this when they work with prospective sellers, is do an analysis of what an asset sale would look like and what a stock sale would look like, and what would, just using a hypothetical example, what would the tax result be? So I encourage, when you're marketing your company, to do that. I told you, Steve, I think once when we were sitting down at another event, that getting a company ready for sale is like getting a house ready for an open house. So I think you should stage it. You don't want to have dirty carpets and curtains that are falling off the rods. You want to put yourself in the position that it looks absolutely the best and pristine as possible. And there's a couple bullets that I'll just touch on quickly. The hot button for me in the deals that I'm seeing, particularly with out-of-state buyers, because they're all afraid of California employment law, is employment. So are you paying your people correctly as exempt or non-exempt? Are you paying overtime? Are you tracking their time properly? I feel horrible for employers in this state, because I have numerous clients that have come to me, unfortunately, after the fact, that are really trying to do the right thing. So, for example, you need to have a second meal period when somebody has a certain amount of overtime, but that can be waived. But I believe it has to be waived in writing. And so I had a client that came in, wasn't giving second meal periods, and got the waiver verbally. And next thing you know, there's a class action, and it was a very significant amount of damages. So they're trying to do the right thing, but it's a minefield. But try to clean that up, because buyers are aware of that, and they want to make sure that they're not stepping into that. So I encourage you to review your handbook, review offer letters if you have them, make sure that you're in good shape on that. Also, you want to protect your human capital, your people. And we're in a situation in California where you cannot have enforceable non-competes. So buyers insist on having strong confidentiality and trade secret protection, which you can do. It's frankly the only thing that you can do. So every employee at every level should be signing a confidentiality provision in your handbook, and a separate, in my opinion, confidentiality agreement. When you have something like that and a buyer sees it, they know immediately that this company is well run, and that whatever you're selling, your products, you have customer lists, whatever your secret sauce is, that's going to be protected, and therefore should be attributable a higher value, which is what this is all about. Intellectual property, really here the focus is create some barriers to entry. So get patents where appropriate, trademarks, strong license agreements, service marks, copyrights, etc. Buyers love to see registered intellectual property, even domain names. That's not necessarily registered intellectual property, but it has significant value, particularly if it's something that attracts a lot of attention on the internet. With respect to contracts, here the piece is, take a look at unusual provisions. Sometimes you're scrambling to land a big client and you don't really want to pay attention to the 42-page document that comes along with the good deal. But the buyer is going to take a look at that. So make sure that there aren't unusual provisions in there that may not be attractive to a buyer. There's an exclusivity provision maybe where you can't work with anybody else in a particular state. Or there's most favored nation pricing, like you can't sell to anybody else at a better price than what that person is paying. Is this contract assignable? Those are the kind of things that are great to deal with up front.
Great, Mike, thanks. As you were talking about these different value enhancers, I couldn't help but reflect. I wanted to get your comments on a thought I had, and that relates to this whole aspect of messaging and how you articulate the story so that it comes across in a way that's truthful and transparent, but also appealing. Could Mike, maybe Mark, could you speak to that a little bit about how the importance of that in the process? Does it have a great deal of importance, or is it secondary? Tertiary?
No, certainly. I think positioning is super critical, and that gets to sort of the marketing materials that we develop. But that's only after fully understanding the company at its core, and doing a full-blown assessment to be able to put that together. We do need to understand its history, its place in the marketplace, and where it's headed. Back to that growth story that we talked about. What are the opportunities out there for the future?
And that's something you help your clients with.
Absolutely.
Great. So we've spoken about those attributes that add value. So let's talk about what might detract or reduce the value of a company. Mike, you want to jump in first?
Sure. I would say, Steve, really it's the reverse of what I described above with respect to employment and intellectual property and contracts. I guess the other thing that I would add is under the title poor corporate housekeeping. Most everybody on this webinar, I'm going to go out on a limb and guess, really don't like to have board of director meetings on an annual basis, are not that good about
Unless
keeping.
they're in Hawaii, Mike.
Yeah, exactly. maybe don't do a great job at keeping minutes every time that they renew a letter of intent, line of credit. Probably don't have that approved by the board. Maybe haven't even issued shares or membership interest units.
My ears are closed on the line of credit topic.
So I'm not trying to make you feel bad, because usually you can get away with it and not have much exposure, except in two circumstances. One, if you're involved in a lawsuit, because then the plaintiff is going to want to see if they could pierce through that corporate veil and get individual liability. And even if they can't, concern you enough that you're going to settle at a favorable price for them, or in a sale. So as you can imagine, a buyer in a stock sale actually kind of wants to make sure that they're getting 100% of the stock. And if you don't have a stock register and you haven't done your filings with the California Corporations Commission or the SEC, which are very easy and inexpensive filings, by the way, but if they don't exist, then there's a concern about equity ownership. And same with titled, assets and that sort of thing. So it's a fairly easy, inexpensive thing to do. And I acknowledge that it's annoying, but it really does pay dividends big time. Again, the curtains falling down, the dirty carpet. If somebody digs into your corporate housekeeping and it doesn't look good, they're concerned, well, what else is wrong? And then, like I said, Steve, the employment, IP, ownership issues, contracts, really it's the reverse of what I described above.
Yeah, no, it makes sense. Totally makes sense.
Well, likewise, on the business issues, a lot of the detractors are the flip side of what would be enhancers. So, if you're looking at flat or downtrending sales, that can be problematic. Again, same thing with margin compression or erosion, and in both cases, sort of what the fundamental underlying reasons for that are speaks to the potential health of the company. Customer concentration can be a big one. Any reliance on one customer for significant revenue, or if the top three are more than 50%, that needs a lot of explaining, or a way to get a buyer comfortable with it. And sometimes they just can't, depending on the percentages and what the situation is. Pending lawsuits or unresolved liabilities or skeletons certainly can cause a problem. These are always important to disclose early, to your advisors first, so that there's an understanding there and we can get arms around what it is, try to mitigate, remediate, and resolve those in a way that they're not going to be a detriment long-term to the value. A big one, and we see this more frequently than you might think, but is no projections or an inability to project. And that's a must when you're entering the process. You've got to be able to have something that's reasonable and reliable. And just starting that out when you're going into a process, you haven't really tested your methods. You don't have a track record there yet. So doing that now, if you're not, is very critical. Non-GAAP financials is an issue. Simply put, they need to be GAAP so that they can be relied on. That would be something that would need to be fixed and restated as appropriate. And if you're not doing a review or audit, might be a necessary step to at least get a review, get reviewed financials, especially for the financial buyers. If you happen to be in a highly competitive or price sensitive marketplace, that can be a problem. That it sort of brings up risks of either lost sales or reduced margins when you're in that environment. As well, if there are little or no barriers to entry. I've heard this phrase used in the past in these kind of environments where, I'll have a buyer say to a seller, I don't need to buy you, I'll just take your customers, and they mean it. So without that differentiation, if it's commodity, if it's price sensitive and very competitive, that can be a problem.
So I think for some of these things, but not all of them, it speaks to what we spoke about earlier about the story. But some of these things can be explained and they can possibly be mitigated. But this is where telling the story, I think, can make a difference for some of these items, not for all of them, but for some of them. So I think we don't want to lose sight of that, the importance of that. So on to the next topic, which is you both have seen, quite a few transactions, and you've seen some fall apart. And what is it that's killed some of these deals, and how could they have been prevented?
Sure. Well, first one here, quality of earnings findings. Quality of earnings is it's really an audit. It's a specialty audit that's done typically within the due diligence period. It really tests whether your profitability is what you say it is or you think it is. It's sort of can be thought of as an audit of a company's economic engine and its sustainability. So it really gets really under the covers.
And who does the Q of these typically?
That's typically an outside CPA firm contracted by the buyer.
Okay.
Mm-hmm. We just talked about forecasts. So assuming now that you've made one and hopefully have been doing them for some time, if you for one reason or another are not meeting those forecasts during the due diligence or closing period, that can be really problematic and can literally kill the deal. It gets to, what I said before, having the discipline, the budget and forecast ability ahead of time so that it's not just now being tested when you're in a sale process. If you find yourself in that situation and we're far along in due diligence and in the middle of the contract and you're not making the projections, it can oftentimes drive a renegotiation or a haircut. And if you're not prepared for that possibility, could cause an owner to wait it out or walk, wait for the next year or the next round. If we're able to show that it's a one-time blip, that it's explainable and otherwise you're on track and the fundamentals are good, we might be able to get through it without a reduction. Next would be major changes in customer contracts or relationships. Obviously, again, depending on the concentration or the reliance on that revenue or sort of what's underlying those changes.
Mark, I can take the next one, undisclosed or unknown risks. So Steve, what I tell my clients is if I don't know about a problem, I can't fix it. And there's almost everything that really can be fixed. A quick example, at a client that one individual owned a corporation he had created 10 years before, an Apple online help desk for Apple users and Apple products. All of the underlying technology was created in Belarus. So I asked him, do you have all of your IP locked up? He said, of course. Yeah, we're in great shape, Mike. Everything's clean. So when I started to see the documents, I asked him again, where's the license agreements or assignment of intellectual property? And he sent me a non-disclosure agreement. So unfortunately, he was under the mistaken impression that he owned the technology, and actually all of it was owned, just by the way law works with independent contractors, in Belarus. So instead of panicking for more than a couple minutes, I said, do you still have a relationship with this software group? And he said, yes. I said, well, let's create a license agreement along with a new project so that there's brand new consideration. In the agreement, we will call out clearly that everything that they've created is owned by you, and we'll have an assignment as an exhibit, and we'll get it signed, and that will take care of, quote, the problem. Able to do that. So when we uploaded that document into the online data room, which is typically how deals are done these days, the buyers didn't even know there was a problem because there wasn't one anymore. So it got resolved. And I was very grateful that he talked to me about it. I asked the question, but grateful that we were able to handle that before and not have to deal with it during due diligence. That's the last thing you want to do. I mean, these buyers, even the ones that aren't that sophisticated, will at least run lien and litigation searches because it's all public information. So they're going to know most of your dirty laundry, whether you would like to share it or not. So the best thing to do, be upfront and transparent about it. And if we can't fix it, and we really almost always can, then we can deal with it in a way where it won't become a deal killer. We'll increase the escrow, or we will carve out the indemnity. So a typical indemnity would be 18 to 24 months. We'll make it 48 months for this particular issue, just to put the buyer at ease that we're not trying to load off on them exposure on this one particular thorny issue, but that it should not be a deal killer. And that's almost, Mark, in my experience, I don't know about yours, but that almost always resolves the issue.
Right. Now that gets to a couple bullets further down, makes me think of the lack of reasonable flexibility. That's one of the things that we appreciate about you, Mike, is being more business oriented than necessarily technically legal on some of the deal points in a purchase agreement, is to know when to flex on things like reps and warranties, indemnifications, and find ways around where what's at issue is a assumable business risk that the owner is willing to take when it makes sense. And your ability to explain that to the business owner and ask the right questions so that you can identify properly what that risk is, lets us sort of get the deal done instead of just saying no or pushing back.
Well, I appreciate the compliment. I'm gonna have to put on my filter so you can't see me blushing. One bullet point that I think we inadvertently skipped, Mark, was the bad or incomplete LOI, which I'll just touch on real quickly. If you were in the middle of a deal, Steve, and there's a LOI that basically is an agreement to agree and doesn't address key deal terms like the structure of the transaction, compensation of the key employees, post-closing, variety of other things, then I've seen frequently you get a month or so into the transaction and then there's a pause because there's something that wasn't negotiated. The people thought they had a meeting of the minds, but that's because they kept it at such a superficial level that they didn't dig in. And I'll get into that a little bit more later about what digging in an LOI means, but it is a result of a bad or incomplete LOI.
Now, Mike, so I want to ask you, this is interesting because does that mean that when they reviewed and executed the LOI, they didn't seek legal counsel?
Yeah, well, sometimes they do have legal counsel involved. The crutch with most people, Steve, is that letters of intent are almost always non-binding.
Okay.
So people make the assumption, well, if it's non-binding, then we can just sort of figure it out. And they don't carefully scrutinize it. So they're leaving significant things out, like non-competes and representations and warranties and indemnities will be as agreed upon by the parties, or per customary standards. It looks innocuous, but there's millions of dollars baked into that sentence. Millions of your dollars if you're the seller. So you want to know, for example, what's going on there. Another one, which is a key bugaboo, is if you've got a stock structure, which to a seller is like terrific, this is what I dreamed of, this is fantastic, but then hidden in there is a line like buyer will be able to take advantage of applicable tax elections to treat the transaction like an asset purchase or something, usually even more innocuous than that. So that's kind of a hidden way of them giving themselves the ability to do what's called a 338H10 election. It differs on the type of entity, but giving them the ability to treat a stock sale for tax purposes as an asset sale. And so it's those kind of things that's getting a little bit granular, but it's those kind of things that are particularly troubling if they come out later, because there's significant deal terms that would be several, depending on the purchase price, multi-millions of dollars of money that the seller will not get that they were counting on.
So Mike, are you advising and advocating that in these LOIs, you should try to avoid these sort of general terms and conditions?
Yeah, it's a good question, Steve. So I'm a big fan of a robust LOI.
As are we.
And what I mean by that is take the time. The purchase agreement is going to be 45 or 50 pages. So not everything in that purchase agreement could possibly be in a letter of intent. Okay. But take the time to get another page and a half of key deal terms in that letter of intent. It will really serve you well. I know it's non-binding, but it really becomes ethically and morally binding, even on lawyers.
And so the buyer's counsel typically is the one that will draft the purchase agreement, and a well-constructed, well thought out and thoroughly negotiated LOI should serve as the blueprint for them or that department to draft a purchase agreement that follows the business and legal points that have been agreed to.
That's well stated.
If all of that is done, then there should be no anxiety or, oh my gosh, when we get that first draft of the purchase agreement, and if there's a mismatch, it's easy to point right back to the LOI and say, excuse me, you missed this part right here.
Yeah, and it really is, even though it's non-binding, people really take it very seriously. And so M&A counsel, it's professionally embarrassing if you have to go back and say, look, we made a mistake, or my client is changing their mind in the LOI or whatever, even though it's non-binding. So that's something that you want to avoid. And it's a deal killer, depending on how big it is, right?
Right.
And you're about to invest 120 days, maybe 90 days. You have lawyer's expense, accounting expense. Some of your key employees are going to be working half time on this deal, or you are. So don't do that without making sure that you really do have a true meeting of the minds.
So this, the final two bullet points, I think, are important ones too. This not locking up key employees, I think, is a big one.
Yeah. So again, getting back to the human capital piece, Steve, again, in California, you can't have an enforceable non-compete. So an employee can always go across the street and work or start their own competitor. So what you need to do, it's kind of a carrot and stick approach, is there's a variety of techniques. So there's phantom stock, stock options, restricted stock, forgivable loans that vest over time. Those are positive, offer letters, change of control bonus in the event that there's a deal that if they stay for a year, sometimes 18 months, 2 years, they get a significant bonus as part of that. That's the carrot part. And then the stick is, we know you can maybe go out and compete with us, but you're not going to be able to compete with our customer list, with our secret sauce, whatever the company jewels are. Lock down those trade secrets, because California has adopted the Uniform Trade Secret Act, and that has some significant protections for companies that jump through the right hoops.
And this last point about attorneys who don't know what they're doing. So what situations have you seen where prior counsel has just made mistakes or faux pas, or just was in over their head, over their skis, if you will?
Yeah, for purposes of this,
And not to bash anyone, but just to point out what the
yeah. For purposes of this discussion, I would just say lack of sophistication. It's really easy if you're not knowledgeable about a particular provision or a particular section of an agreement or a concept, then it's really easy to say no, because then there's no exposure to you as the lawyer. So your advice is more preventative medicine, or protective medicine, than it really is good advice for the client. So I think it's important is to find a lawyer that practices in this area, and then in particular has experience with, okay, what is a normal escrow amount? Is 20% of a purchase price a normal amount? Is 2% a normal amount? What is the standard, so that you can give good advice and not say no, but perhaps say, no, I wouldn't do it that way, but I would recommend doing it this way, because 2 years ago I had a compromise in a deal and this worked. And the allocation of risk there seems to be fair to both seller and buyer, or whatever it is.
Good. So before I forget, I wanted to mention again that if you have any questions, feel free to put them in the chat box in the chat, and we'll definitely catch them at the end. Mark, let's now that we've talked about value, enhancers, detractors, let's talk about the process itself. So why don't you give us some insight on that?
Sure. So the slide you see here is somewhat busy, and that's really just the high level, if you will.
Thanks for sharing. Thanks for keeping it high level, Mark.
Yeah. Going through an M&A process, there's a lot of moving parts. And it does take a while. The entire process can take anywhere from 9 to 18 months. It really just depends on the situation. The first step here, really, we're talking about preparation. And over the last year or two, we've developed an approach that has worked really well for our clients. It's our saleability assessment. And going through that and at the outset really not only uncovers all the key positioning points that we talked about before, but it helps an owner and us understand the range of market value expectations. It's also going to identify if there are any showstoppers or issues or things that we need to address prior to going out to market. So, one of the benefits of that as well is that all the work that's done in that phase is leveraged directly into that next phase of creating the marketing materials. Marketing materials consist of what's called a confidential information memorandum, or a CIM, and a teaser. The CIM, some people historically called it a book, can be 15 to 25 pages, and really provides that profile of the company and its opportunities, historical financials, projections, where it's headed. Really allows a would-be prospect to get a sense of what this opportunity is about, and self-identifies what their interest level would be with it to continue the conversations. Ahead of that is a one-page teaser, which is a no-name one-page document that we send out broadly to the identified prospect group. And it's only after an interested party signs a non-disclosure agreement that then permits them to get the SIM. And so while we're putting that material together, we're also working with the client and also with working in our subscription-based data services to identify would-be potential acquirers, both on the strategic, corporate, as well as private equity side. We always like to look at both. They represent two different types of transaction, which we won't get into detail here unless we have time at the end. But once that's done, say we've got 50 to 100 or more potentials, we'll go out and do the initial outreach via email and phone call follow-up, and look to get their attention and get those SIMs out into the marketplace. From there,
Mark, how challenging is it to identify who those recipients are going to be, who those prospects are?
Not so much. I mean, between we subscribe to Capital IQ, as well as PitchBook, which are two tools of the trade, high level, broad industry databases and research mechanisms for us to use. But we also want to engage with the owner. I mean, typically the owner is going to know firsthand, who would be potential vertical integration acquirers, or maybe it's a larger competitor or the like, to go to as well. So there's that. And then we also keep our own proprietary database of private equity groups, probably on the order of 500 or so, that we either talked to. I mean, Chris and Patrick and I get calls every week for a check-in as these guys are beating the bushes for deal flow. And we'll have a check-in with these guys, and so you get to know them. But then also the wealth of lists of people that we've gone out to before, been involved with in a mandate, not necessarily the buyer, but we may have talked to or sent SIMs to 20 or 50 participants in a given engagement and had those conversations. So we've got sort of our own set of go-tos for certain types of deals, certain industries, and the like.
Okay.
So with that, we're out in the marketplace. We're fielding all the initial conversations, follow-up questions, and so on. At the point we are able to determine those who are, true would-be highly interested buyers, we would facilitate a conference call or Zoom these days with management where they can answer the questions. They can talk directly to the owners, to get those questions answered, get a feel for chemistry and the like. And so that's the next step. From there, they, those who are truly want to engage, want to make an offer. Next step is an IOI, or indication of interest. Think in terms of a term sheet, a 1 to 2 page that outlines either the value or the range of value, as well as the approach that they would take in an acquisition, sort of letter of intent light, if you will, or offer. If we've done things correctly and there's high interest, we've got maybe half a dozen of those that we're considering. We'll work with the ownership to evaluate those, think about who would be the best partner, who we want to, reach out to for letters of intent to go to the next stage. And so then it's refined further, where we would look to receive a letter of intent between, again, multiple parties to evaluate actual offers. It's at that stage where we're looking at letter of intent, or we're close to making a selection, where we bring Mike in, typically, because now we're talking about legal aspects along with the business points, and want his input on evaluating those.
And Steve, that's where I feel like I can add value because of the robust LOI concept that we're talking about. The other categories and some of the other subcategories within this, ClearPath does an excellent job. And just briefly, I've done a number of deals with ClearPath, and not only are they good at the things that you would expect them to be good at, which is finding buyers and creating an auction, but they're really good at a lot of other things, which are I find to be incredibly valuable for a company that's getting ready to sell. They have more of a consultative model. So they're not just focused on a success fee. They're not just focused on getting any deal done so that they can get that commission. They're focused more holistically, trying to get the company to be in a better shape, like, the ready to get ready for sale. So if the company doesn't even sell, or maybe you decide you're doing so well that you don't want to sell at that time, your company is going to be in much better shape. And then most deals have what's called a working capital expectation, so that the buyer would expect there to be a amount of accounts receivable, sometimes a little bit of cash, over AP. That's an extremely overly simplistic view of working capital analysis. It's actually quite sophisticated, and ClearPath is excellent at doing it in advance, negotiating on behalf of clients. And I've seen, Steve, in one case, the swing was, I think, $4 or $5 million, Mark. It might have been more than that. This was a deal that was over 100 million. But typically, they're always several $100,000 to $500,000 on the right side to sellers, meaning the net working capital expectation is less, so more cash stays with the seller. And that is not something that most M&A advisors or business brokers can do. I mean, I'm sure most of the people out there are getting cold calls by prospective buyers and business brokers, maybe daily in some circumstances. But really work with somebody that knows what they're doing, because it'll pay you back big time.
Yeah, and I think this preparatory phase, although we've on the slide, we haven't talked about how long that can take, but that could take, for some companies, that could be years. It's not something that is going to happen in 8 or 10 or 12 or 15 weeks necessarily.
Really based on fact and circumstances.
Absolutely, Steve. I mean, it runs the gamut, because sometimes we'll be approached by a client they're set on going to market and they're in really good shape and they want to go. Right. And that can be, literally we can get going in a couple months with the prep. We'll do the saleability. Yes, you're good to go, and just roll right into go to market activities and so on. But as you say, sometimes it's early on. They're thinking about it. They want to do the saleability. There are some things that can be worked on. We're able to explain, sort of what that uplift might be if they're able to correct issue 1, 2, and 3, or even, do even more with what I call the green areas. We use a lot of color: green, yellow, red. Those things that they're doing right, to do more of that, to enhance those opportunities. So you're right. It really it depends on, again, the time frame and that kind of thing. That sort of leads into even ahead of the saleability. Another piece that we have been doing with clients is something we call the painted picture, which is really taking a step back and looking holistically at where do you want to end up in 3 to 5 years on numerous points, in your personal life, in your business life, in your spiritual life, and so on, and not worrying about how to get there, but what's that picture look like? Then we can backtrack on the how.
Yeah, I think that getting a business ready for sale isn't necessarily the same as getting a home ready for sale, where you put some paint on the exterior, put some new carpeting or flooring in, and you take it to market. That's a little different. The process is different, and how you get there is different.
They're all different. Just depends. Again,
that's the key is they're all different.
Yeah. So just quickly back to the process. Let's say we've got a signed letter of intent. Typically, that's it's an exclusive arrangement, so you're not still out shopping. You've agreed to go down the path, and so then when you enter the due diligence period, where they're going to send an information request list that's 100 items long. We use a due diligence room, electronic room, to be able to pull in that information. We look at everything before it goes in, before it goes to the other side, to make sure, we've used the word position a lot, make sure it's properly positioned, or, that there's not something that we need to address before we present it. And then at the same time, the other side is doing their due diligence. There'll be, business diligence by their operations or business team. There'll be financial due diligence, typically third-party CPA firm. The legal folks are obviously involved, and sometimes, a lot of times, this quality of earnings exercise we'll go through as well. Simultaneously, somewhat staggered after that starts, you'll have the purchase agreement drafting and the back and forth negotiation with that. Mike is leading that charge, but we are heavily involved in working with him and evaluating it as well, because it incorporates all of the business deal points, and we've got a lot of experience with purchase agreements and their terms as well. So you get through due diligence, you get through the purchase agreement, and you start to move toward closing. There's legal filings, transfers. We've got to look at how the fund flow is going to work between the funding sources and where the money is going to, and a lot of signatures. And then with any luck, you have a closing day and break open the bubbly.
So let's launch into the last topic before we get into the Q&A session, and that is, let's talk about when is a good time to bring professionals into the M&A process. Who wants to tackle that first?
Well, I could talk about, for me, it's at the LOI phase. Occasionally, if there's a lot of non-disclosure agreements that are signed and they're heavily negotiated sometimes, and they get a little bit tricky. So the M&A advisor or the clients would want me to look at the suggested changes to the non-disclosure agreements. The current deal that I'm working on, they've had 72 non-disclosure agreements. Half of them have just been signed as is on the M&A advisor's form. And the other half, some of them were almost entirely rewritten in a very, not industry standard way. So I've been involved in the non-disclosure piece there. Typically, however, I got involved at the LOI phase. And then Mark, as you can see from the sell side slide, gets involved well in advance, getting ready, get ready.
And sort of reiterating a theme, of early and often is ideal. Obviously, from a getting ready to get ready, but really I'll pick on sort of one circumstance that has come up even more frequently and sort of drives that urgency, and that is what Mike mentioned earlier. We're getting a lot of clients that they're getting the cold calls. They're being approached by strategic corporate folks, would-be buyers, private equity groups directly. And we're getting that phone call after the fact, after they've already started engaging and where they, in some cases, have already started sharing information. And invariably, that being opportunistic that way is very costly. Sharing that information too soon, if you're providing unrefined financial information with no positioning story, the buyer is going to scrutinize it for flaws. They may not be looking at the upside correctly, and we've not had the opportunity to do any of the positioning. And then, even if it were in great shape and it were fine-tuned, this process of one, if you will, puts you in an immediate position of weakness. There's no competitive process, there's no leverage, and that typically would translate into a reduced value or offer. So, the other thing that could happen is that you come to find out your company is not actually sellable. So for all those reasons, we'd like to get in there sooner than later. When these situations do happen, and we've had one more recent, we had one a year ago. They can be tricky to navigate because you've got a party who's typically hot to go and engaged, and you need to delicately put them on hold while we try to hurry and catch up and get prepared and prepare the materials and the analysis, so that we can conduct a more competitive process. Now, in a more controlled situation, on the sort of the flip side of that, we have given a favored or a likely candidate an early look. This is typically in the case with a competitive situation, where we'll allow them a look for a preemptive offer, but it's only after we're fully prepared with a package and messaged clearly that if we can't get to owners' expectations, that we will go to market. They can be part of that process and so on. But in some cases that can be worth doing because it does put pressure on achieving out of the gate what the owner's after, and without going through that whole auction process, if you will.
So is it fair to say that if a PAG were to reach out to a company, that they would they're hoping to maintain that communication between their group and the seller to try to find a bargain?
They would love that. We, in the nicest way, get in the middle. They don't always necessarily like it. But yeah, know that, from the time we're engaged in that instance, the communication does need to flow through us. It doesn't always work quite right. They'll go around and so on, but particularly as it relates to negotiation, I mean, it's not the proper approach, if you will.
Mark, share the story about the cold call from Florida.
Yes, so we had a client, I'm going to say 3 or 4 years ago, that was a friend of Mike's. Wonderful business, high margins, service business came through. They've been approached with an offer from a public company for a range of 21 to 23 million. They're seriously considering accepting it. And Mike introduced them to us, and our analysis and restatement of the financial results put them closer to the 45 to 50 million range, almost more than double. Really due to their high margins, they had a very high growth rate and a financial reporting period. The buyer was looking at the prior year end, and we were in the middle of the summer, just not proper metrics, if you will. And so with that, we went back and forth over the next 6 months, ended up no deal with that group. And good thing, within a year, they ended up transacting for over 80 million. So that's where I say opportunistic, things can be costly. That was a big one. True story.
So when you were talking about that, I couldn't help but think about the scene in Wall Street with Gordon Gekko's negotiating with Sir Larry Wilder about the sale of the company. And he brings in his analyst and says how much more the company's worth. Now the price keeps going up and up and up. So that's sort of what you do, but in a less obtrusive way, if you will.
Yeah, the nicest way possible.
That's possible, exactly. Mike, any more comments before we wrap things up here and move into some Q&A?
Yeah, no, I don't.
So maybe one thing, maybe one question you could address is, what are some realistic expectations for the seller of a company after the sale's closed in terms of what their involvement's going to be?
Yeah, that's a good question, Steve. So I would say realistically, they should expect to, regardless of their age or involvement in the operations of the company, there should be an expectation that they'll be there at least 6 months to a year for a transition period.
Okay.
Sometimes to the extent they're more actively involved and have significant client contacts and really very important to the operations of the business, then the expectation would be that it would be longer than that.
Mm-hmm. Mark, you seeing the same thing?
Yeah, that's standard. Owner should be expected to stay on for a transition at a minimum.
And is that usually, if you will, memorialized through some sort of agreement or contract?
It is. Yeah, it's stated in the employment agreement.
Yep, and it's referenced in the purchase agreement, and not to be a broken record, but it would be great to reference it in the LOI, just so there's an understanding of what the expectation would be. Is, an unspoken term for somebody that really wants to retire may appear to them to be a couple of months, whereas the buyer may think it's 5 years. Get it in writing. It's really only it's one sentence at the LOI.
And I guess the same could be said for some key employees too.
A little bit trickier. Oh, sorry, Mark, go ahead.
No, I was going to say, I agree, can be trickier, but also typically stated in the LOI and also memorialized in employment agreements for the key execs with a lot of times there'll be a stay bonus, after year one post close or more kind of thing to keep them there.
The tricky part that I'd say, Steve, is just the buyer doesn't necessarily know who the key employees are at the LOI phase. So it typically just says key employees to agree to XYZ, contract. It's pretty generic, and it's one of those areas that I sort of have to acknowledge probably should be generic at the LOI phase.
So in terms of the market, you mentioned the dominance of PEs in terms of deal activity. I would assume they're facing they've raised a lot of capital. They're facing a certain amount of pressure to deploy the capital. Maybe you could speak to that a little bit and how that's affecting deals and transaction value.
Sure. Well, private equity is always, I've been doing this for 15 years, and for me, it's been a continuation of the theme. They're always fundraising. They're always looking to put capital to work. So yes, we're at record high levels now. Okay. But that's what they do. And their mandate is to, achieve these double-digit returns, sometimes in the 20+% range. You can't do that with cash sitting on the sidelines. So they need to get it invested.
Yeah, I agree. And oftentimes private equity groups, they get 20% of the cash commitment up front, and then they basically have a call, in 30 days, we're going to ask you, you've already made a commitment, investor, and now we're going to call because we found an opportunity. We want your additional $800,000 or whatever it is. And the way they're compensated is largely dependent on deploying that capital and getting returns on that capital. So if they don't have anything in there, then they're getting, for them, modest compensation.
What's magic about 20%, Mike?
No magic. That was just a hypothetical.
Okay, is that something is that a term that's typically negotiable, or does that tend to be the benchmark?
The range is 10 to 30%. I mean, private equity groups don't want to take the money unless they can use it, because they typically have a promise where those people get paid before they do, with a preferred return. So once you take their money, you got strings attached. So, but you also don't want to be in a position where you can't act quickly because you don't have the money. So that's dependent, facts and circumstances, on what the private equity does, where they invest, early stage companies, large companies.
So in terms of, we didn't talk a lot about the succession of management succession and a management buyout, if you will.
Mhm.
But, let's just talk about that just for a little bit and talk about certainly we see the potential benefit to that in terms of continuity within the company. But then there's also the challenges that MBOs face in terms of, often the MBO group doesn't have the adequate capital to make that happen. Is that typically what you're seeing in management buyouts? That's kind of the yin and the yang of it, if you will?
Mark, did you want to take that?
Yeah, no, I think that's true. It can be a challenge to, look to the key execs to, have the wherewithal to be able to get their checkbook out to buy that stock at a meaningful level. Having said that, I am familiar with a couple of groups, private equity groups, that their sole focus is management buyout, and they've been able to do it with a structure that allows for that key management to have meaningful participation up to the 20% level, with a much reduced investment level. So there are ways to do it, but it can be tricky. What might be interesting to talk about, we did get one question submitted ahead of time that asked about consolidating ownership under, it was consolidating ownership under complex family shareholder structures when you have a simple majority ownership. And so, not management buyout, but just more shareholder or partner buyout situations. Generally speaking, the first thing you're going to want to do is take a look at your governing documents. What do they say? What does the shareholder agreement say? Do you have a buy-sell in place separate from a LLC operating agreement that sort of dictates both the terms and the process, and even the approach to establishing value for that buyout? Assuming you're looking to buy out some or all of the shareholders, then you're going to want to assess the market value to understand what you're willing to pay, or for that matter, if the formulaic buyout, if that exists, if it's a good deal for you. And then look at the structures and approach. Typically, you're looking at a stock redemption where the company buys the stock back, thereby increasing your percent ownership. This can be sometimes funded with company cash, and then just determining the terms, how much down, how much in the form of a seller note over a term of years, that kind of thing.
Mark, can I address something real quickly on that issue too? So this would be something where I would encourage people at the beginning, when at all possible, of the organization, deal with it then. Because in California, a majority shareholder can sell the assets. You only need a majority approval of the board and the shareholders. That's true for most LLCs too. But to sell the stock, you obviously have to sell 100% of the stock. Most buyers want all of it. They just don't want part of it. Right. So if you've got 10 shareholders and 7 of them are in a minority that don't want to sell, then you're really stuck, unless when you started the company, you put together a buy-sell agreement that included a drag-along clause, for example, so that if the majority wants to sell, they can drag along the rest of the minorities. They all get the same pro rata consideration, but you can force them to do the sale. And that is binding in California, and as far as I know, every state. And so those kind of things, basically, they're like business prenups. Incredibly valuable to deal with that up front, because otherwise you're in a position, like Mark said, which is realistic, which is you really are negotiating with people to buy out their interest. And they don't really there's squeeze out mergers, and there's other techniques like involuntary dissolution actions and different things that you can do, but they're all challenging and time consuming and expensive. So if you can deal with it up front, that's the best way to do it.
Yeah, we've seen situations that's in these internal transactions, or where there is a transaction that involves key employees or even family, that the sellers have played a meaningful role in financing that transaction.
Mm-hmm.
And there's been this cooperation from the seller to facilitate the transaction. You don't see that all the time, but I've seen that in certain situations.
It's really an economic gut check time for a seller, because do you want to maximize the purchase price, or do you want to do the deal with loyal employees? And the gut check piece is you're likely going to have to do seller financing for a large part of it, or it won't work.
Right.
Whereas if you're selling for a third party, it'll be cash,
That's very, very true.
And, in that case too, you're assuming the risk and investing in that team to be able to take over and run the company, and in such a way that it allows them to make those payments and that it prospers and so on. So you're putting a lot of faith, some level of risk in that next stage.
Yeah, I would say that if your goal is to walk away after 6 or 12 months, that is not the path you should take.
It's gonna have your attention, certainly.
So we have another question, and that is, how is the current shipping, the shipping crisis with respect to, containers, cost increases, problems with rail, et cetera, affecting the transactions for consumer goods companies? And are buyers leery of the current situation given these dynamics?
Do you want to take it, Mark, or I could take it?
Yeah, I don't have, it's too new for me to see that level. I'm seeing more broadly the issues of supply chain and pricing and so on with the companies that I'm working with more on a day-to-day operational basis, in more my CFO role for some of our clients. So just in terms of impacting operations, it's significant. One, rate I heard was, shipping containers that were 2,000, a year ago, is 20,000 now to get one across. And, increases in other clients in paper and plastics industry, in food, cost of goods, price of pork, et cetera, has had a very challenging impact on the company operations, certainly.
Steve, what I'm seeing is sophisticated buyers are working through it, meaning they realize that it's temporary. And so they're looking at what does the 5-year horizon look like. I would say compassionate and sophisticated buyers, the little more cutthroat, and I don't necessarily mean that to be entirely negative. Buyers are trying to take advantage of it because they think it's temporary, but they tell the seller, hey, we don't know when this is going to end. So we have to assume that this is the new normal. So the way that we've been able to bridge that gap is with an earnout. So the seller says, look, I'm confident that in 6 months from now, this is going to get sorted out. So I will allocate some of the purchase price to an earnout that I will prove that I'm right, or you don't have to pay me 20% of the purchase price. So I will earn out that part of it. So when you're so confident that you do that as a seller, and I see Mark nodding, then the buyer really has, little argument about it, and just say, okay, well, let's go ahead and do it, because you're taking the risk away really for them.
Having said that, and Mike, you would agree, constructing earnouts and then with, proper metrics and containment, if you will, can be very tricky.
It is a challenge, but again, avoiding a deal killer, right?
Yeah, exactly right.
And Mike, you used the word temporary and 5 years in the same sentence. So that's a long temporary. It's all like
No. I meant they know they're looking at a 5-year horizon.
Oh, I see what you're
and
saying.
They think it's going to be done in a year.
Okay.
But they're basically, they're reducing your EBITDA based on now. And so you're getting a multiple based on now, which a year from now probably is not fair to you as a seller.
Well, and then there's also the dynamic, which is obviously negotiable, is if there are going to be price increases.
Well, that's true too. And inflation and everything.
A lot of companies are talking about, and we're seeing more and more price increases being pushed through.
Yep, that's right.
Question is, there's no other issue about, is this transitory? Usually when prices go up, they tend not to go down. So we'll just have to see.
Including wages.
Including wages, that's right.
Yep.
So we have another question, and that is it possible to do a stock trade with a strategic buyer and avoid tax, like a real estate 1031 transaction?
Yeah, I'm not a 1031 expert, but you can do like-kind exchanges of stock. That would be about as far as I would go on my expertise. But I do know if that person that asked the question wants somebody that has expertise in that area, there's somebody that's my go-to that I use for 1031 exchanges. I think, Mark, correct me if you feel differently, just to make sure that I understand the question properly. If they sell their stock in a stock for stock exchange, that's effectively a merger, and it should be tax deferred, meaning tax-free at the time of the merger, if I'm understanding the question correctly.
I'm drawing on the one you and I did about 6 years ago. You remember the one, but I'm not remembering the tax impact. But I think that's correct. Again, Mike said.
Mark and Mike, I think this is one that's going to require a little more research to answer, but it's a good question. And we can follow up with the individual that asked that question.
Yep.
After the call here.
Absolutely.
Definitely.
That being said, it's 1:30, and I want to be respectful of everyone's time. I want to say thank you, Mark and Mike, for being part of today's webinar and leading us through this discussion. And also want to thank all of everyone that's on the call that chose to participate or chose to be present for your interest in being part of this. And look forward to hopefully seeing you at other similar events in this series. And again, hope you enjoy lunch. And with that, we'll say goodbye. And thank you very much. We'll have a little Beatles music.
Thank you, Steve.
Thank you, Steve.
See you later. Thanks, everyone.
Appreciate it.
You're welcome.